Good afternoon. Welcome to Capital Account. I'm Lauren Lister here in Washington, D.C. These are your headlines for May 17th, 2012. As world leaders arrive in the U.S. for the G8 summit, not to mention the NATO summit is coming up this weekend, we'll talk about the realpolitik of the U.S. situation when it comes to generating economic growth. Chris Whalen has written about a choice between debt and inflation or war and says finding a way to avoid these two extremes is now the chief concern. He is here. We will talk to him about why. Yesterday, we told you about deposit flight from Greek banks. Today, we talk Spain, where the country is denying reports of a bank run at its second largest lender, Bankia. This as Greece swears in a caretaker government to run things until elections next month. The next step, ideally, towards certainty. This begs the question, though, are we seeing a run on Europe? Go on as we speak. And when things are bad in the economy, it's usually good for people in the business of vice. But are things so bad in Europe that even strippers are threatening to walk? Well, that's what appears to be happening in Paris. We'll talk about it. Let's get to today's Capital Account. All right, before we get to some of those headlines, let's bring you up to speed with the latest in Whalegate, because Jamie Dimon has been invited to testify before the Senate Banking Committee, reportedly. Also, J.P. Morgan's $2 billion trading loss has prompted the New York Fed to examine how banks in its district are managing deposits. Of course, it begs the question if Jamie Dimon gets any say in that. He is on the board of the New York Fed, after all. And also on the Hill today, officials from several financial regulatory agencies were testifying before the House Financial Services Committee on the settlement practices of U.S. financial regulators. So this is a good time to have a little hearing of our own on this issue to talk about regulation and fraud. After all, this is the real F word on Wall Street that no one wants to utter, helped perhaps by their cronies on Capitol Hill. There is a major factor that may be working against victims of fraud. And unless you are an MF Global customer, you may be surprised at what it is. Take a second, think about it. Think of your guest, or your guest rather, while I bring in our guest, Christopher Whalen. He's Senior Managing Director at Tangent Capital Partners and author of Inflated: How Money and Debt Built the American Dream. So, Chris Whalen, I said with fraud, there is this issue that people might be surprised really can hurt victims in getting their money recovered, even if they're the victim of fraud.
That's right.
What is that surprise issue? You've been writing about it.
Well, in the 1920s and the 1930s, we had a lot of fraud, a lot of securities fraud. And it took about 10 years for Congress and the courts in particular to realize that that was the problem. Same thing now. We've had 5 years of Barack Obama, George Bush, and they've done nothing to prosecute fraud. You talked about MF Global. One of the big problems is the victims in that fraud didn't realize that the trustee who takes care of the bankrupt company can't represent their interests.
Well, this is the issue that I want to get to. That is what people would not imagine gets in the way of victims getting their money. And it's actually the bankruptcy law.
That's right.
I want to bring up, you've been writing about this. Let's take a look at how the law is maybe stacked up against victims, something that you've written about. You said, well, many people are confused by the fact that the Madoff trustee has been unable to recover billions in funds stolen from the customers of the Madoff firm, from J.P. Morgan and other banks. The situation simply reflects U.S. law. So you talk about these issues that from Madoff to MF Global bankruptcies are a result of bankruptcy law. Explain what those issues are.
Well, a bankruptcy court's not really a court. It's part of the executive branch.
Okay.
There's only three kinds of equity courts in the United States: district courts, courts of appeal, the Supreme Court. They're the only ones who can make decisions about life and limb and judgments, in other words, to restrain property. In the bankruptcy process, the judge and the trustee are just concerned with the defunct entity. And that's,
with the estate.
That's right, the estate of the bankrupt entity, whether it's a company or a person. So there's really nobody to represent the interests of the third party. Now, back in the 20s, it was very common for the trustee to also be appointed receiver. The difference is the receiver has authority from the federal district court. Very different. So Stanford Group, for example, you had a big fraud, no bankruptcy. The victims in the fraud simply went to a federal judge and said, there's fraud, we need a receiver. And that individual was able to not only get the money back, but he was able to pursue bad actors. He was able to refer it to the U.S. attorney for criminal prosecution. They have much broader powers. And unfortunately, the victims in these frauds, especially when the entity goes into bankruptcy, don't understand their rights. And their lawyers often don't understand their rights. The first thing that the Madoff victims should have done is gone to the federal district judge, Judge Rakoff in this case, and said, look, there's fraud here. You have to either make the receiver or the trustee receiver as well, which they can, or they could appoint a separate receiver whose job would be equity. He would look to see, did any bad acts occur? Was there fraud? And could he recover funds in a way that a bankruptcy trustee can't?
Well, because you argue that once it's in this situation of bankruptcy, not only can a trustee recover funds for victims from third parties.
No, he can't. The trustee can't.
Right. You can't. So that's
he can only
one of the
claw back
issues.
money that's owed to the dead company.
But not to the victims of, if you're MF Global, what was theft.
That's right. So in the case of Madoff, for example, Mr. Picard, the trustee, has tried to sue J.P. Morgan. He's tried to sue other banks and say, look, you knew what was going on here. You should contribute to repaying the victims. Unfortunately, each time he's been shot down. In fact, Judge Rakoff has limited his ability to go back in time and claw back money, even in cases where he can, to 2 years. The Madoff fraud went on for over a decade. So bankruptcy is a very limited venue. This is what people have to realize. And the one time when you can go to the federal district court and get relief is if there's fraud. And people don't understand this.
Because the F word is something that everybody seems afraid to utter these days in relation to some of these financial cases.
Well, look, John Corzine, biggest fundraiser for Barack Obama.
Which is something we talk about a lot on this show. So you think those connections have a role? Oh,
definitely. Because what he did in mismanaging that firm in our business is a straight-up felony count. 5 years, $5,000. Well, and they should be prosecuting him, in my opinion. But unfortunately, Barack Obama is playing the role of the stooge to the large banks, and he's going to let them all go by running out the clock. There's a 5-year statute of limitations on most of these claims.
We'll have to see what happens with that. I want to bring up, there's another point that you make, and that's working against victims in these bankruptcy laws, and that's changes to the safe harbor laws in 2005. Explain why this is kind of the second factor here, and also, didn't banks have a hand in lobbying for these changes?
Oh, totally. The banks got everything they wanted in 2005, and what they've done is said, well, we have systemic risk if you subject the bank to the automatic stay in bankruptcy. In other words, if you force them to wait for the bankruptcy court to make their ruling. So they have a pass. And what this means is J.P. Morgan can facilitate fraud in a firm like MF Global, and they get no hindrance whatsoever. They can just go about their business, and the victims of that fraud cannot go after J.P. Morgan.
Because safe harbor laws mean that if you have customer money, you don't have to give it back as long as you didn't think it was customer money when you got it, or what were those changes?
No, the key thing here is that J.P. Morgan is a secured creditor. They made a margin call on MF Global. MF Global gave them the money that belonged to customers, and J.P. Morgan even asked. They wanted a
letter. They never got it.
Never got it. So I think it was incumbent on J.P. Morgan to say, wait a minute, there's something wrong here. And keep in mind, they're clearing for this firm. They know what the firm was doing.
And I want to get to the bigger picture here, because the conclusion you draw from these kind of two factors, that the trustee can't get money from third parties, also creditors are protected by these safe harbor laws. You come to this conclusion, which is this. As a result of these two defenses working in tandem, today financial institutions can aid frauds such as Madoff and MF Global, to mention just a few, without being brought to task in civil proceedings. And once the perpetrator of the fraud files for bankruptcy, the individual victims often are left without any means of seeking redress, and the bad actors among management and other customers literally walk away. So I guess I first just want you to explain how you believe financial institutions have aided frauds in these cases.
Well, if you're the bank that's financing a broker-dealer, you clear all their trades, you're financing their assets. So by definition, you have a duty to know what they're doing. With the case of MF Global, you had this sleepy little company that used to just execute on behalf of customers. All of a sudden, they start trading for their own account. They haven't raised any additional capital. So where were they getting the money to support all of this? They were getting it from their customers, in my view. When you saw MF Global start to convert retail accounts in some of their subsidiaries into accounts in the parent broker-dealer, this was kind of a hint that there was a problem. This was back in August of last year. That allowed them to steal that money.
And you're saying financial institutions should have known about this, should have been
JP
doing their due diligence
yeah.
on this, because JP Morgan also looked to buy MF Global, so they did massive amounts of due diligence on the firm.
They already had all the collateral. Remember, a broker-dealer is financed. They're not funded. They don't have a deposit base.
Okay.
So a broker-dealer always has to go to a bank to finance their assets. The bank has to know what's going on. It's part of the credit process.
Okay.
You can't say, well, I didn't know. And just, it begs credulity to say that nobody at JP Morgan realized that this tiny, tiny broker-dealer was in trouble. I really think they did know they were in trouble. They got their money out, and now they say, fine, we have no responsibility to the victims.
Wash our hands of it, and the law allows that. So then the question becomes, will there be more MF Globals? Will there be more Madoffs? And because bankruptcy laws aren't changing that I know of,
that's right.
This same pattern will repeat where victims don't have any more right to get their money recovered?
Case. I think if victims were more aware of their rights under current law, I've actually proposed some changes to the law that would help this. But even today, if you know what to tell your lawyers, and if your lawyers know the law, they can go to a federal judge and get a receiver. And I'm not sure what would happen, because if you had a receiver in the MF Global case, it might be that that person could claw back the funds.
So
and then this would end up in front of the Supreme Court.
You need a receiver in addition to a trustee, and a trustee is what's granted in bankruptcy law.
Let me give you another example. FDIC. When the FDIC takes over a bank, one of the few ways they can recover funds if there's a deficiency, in other words, if the deposit fund has taken a loss as a result of the bank's failure, is they sue officers and directors. That's what a receiver does, because they have the power to go after third parties and say, wait a minute, you were negligent, whatever acts that you committed caused a loss to the FDIC, and as a result, we're allowed to go after you. So that shows you how powerful a receiver could be.
And it's literally the difference of a client knowing you need to tell, you as my attorney, you need to tell the judge, we want a receiver, this is fraud, we believe.
That's right, and that's your one exemption, because generally the courts won't allow a bankruptcy court or any of these inferior tribunals to get onto their turf, which is judgments about equity, property, that kind of thing. But this is the one case where it's absolutely essential if you want to fight fraud.
And you know what? This is good advice for anybody listening, because it doesn't seem like there's a lot of movement on the regulatory front that would make people more resigned to feel that their money is safe in a broker-dealer. If you can get it stolen from MF Global, then what, where will this end?
And I have an article about this up on Zero Hedge that we originally published on the Institutional Risk website, but I felt it was so important, I wanted to put an evergreen version of the article up there for people to read. And it's been very popular. It's
a great piece, and when we come back, I want to talk to you more about JP Morgan and some other issues. We'll have more with Christopher Whalen, author and senior managing director at Tangent Capital Partners. Still ahead, too, we've been talking about generating domestic economic growth. So how about some advice from former U.S. President George W. Bush? No takers? Well, like it or not, he'll be offering his 2 cents this summer. We're here to give you our 3 cents on his latest endeavor. First, your closing market numbers, though.
We just put a picture of me when I was like 9 years old on To Tell the Truth.
I have a confession. I am a total ghetto princess. I love rap and hip-hop music and Christian music.
I thought he was kind of a dick yesterday.
I'm very proud of the role that Al Jazeera has played.
You know how sometimes you see a story and it seems so whole and complete, you think you understand it, and then you glimpse something else. You hear or see some other part of it and realize everything you thought you knew, you don't know? I'm Tom Hartman. Welcome to The Big Picture.
What drives the world?
The fear-mongering used by politicians.
Who makes decisions?
Considerable breakthrough has already been made.
Who can you trust?
No one who is imbued with a global missionary zeal.
Where are we heading?
State-controlled capitalism is called fascism.
When nobody dares to ask, we do. RT, question more.
Welcome back. We've been talking about fraud, and if you didn't notice, JP Morgan has a role, has a hand in the MF Global story, in the Madoff story, and of course we have this latest London whale trade gone sour. The question comes up, is there anything JP Morgan doesn't have a hand in these days? But then when you talk about regulation, about making sure that banks don't engage in proprietary trading, reining in risk, is there an unintended consequence of that? Well, let's look at what Chris Whalen has to say. He says, while JP Morgan spins this tale as an outlier and the media complies in this task perfectly, in reality, this is really how a lot of the market generates profit. Thus, not only will implementation of the Volcker Rule have no impact on the risk-taking and true risk exposures of the largest banks, but the reduction in liquidity in many markets in the short run may actually cause the next systemic crisis. I don't know. We're going to have to ask him about that. We have Chris Whalen, Senior Managing Director at Tangent Capital Partners here, author of Inflated, How Money and Debt Built the American Dream. Chris Whalen, you say the Volcker Rule could actually cause a systemic risk because these banks are so big, so responsible for liquidity. I hear ya. I'm sitting here. I'm going, oh, come on. All I want is these banks to stop trading with depositors' money, to stop making these bets, to stop putting taxpayers on the line. So really explain to me why this could be a risk.
Well, half of JP Morgan's profits come from credit arbitrage, just like the whale. It's a very
half. You're saying half.
Right, and remember, half of JP Morgan's business is not funded off deposits, it's funded off the bond market.
Okay.
So the whole complaint about them using deposits to trade derivatives, I think, is a little bit suspect. Also, keep in mind, they lose more money every quarter charging off bad loans than they lost on this trade. And the unit is overall profitable. So I look at JP Morgan, and while I would like to see changes in the risk-taking and everything else, I think this is a big tempest in a teapot.
Really? Well, that's a fitting description to use, because that's what Jamie Dimon called it.
Well, no, but it's true, because I think he had to come out and make this strange announcement after the close last week. We get this email says we're having a conference call. But I really think it's been blown out of proportion. Should this whale have been doing this trade? No, I think he messed up. But it wasn't hedging. These guys were swinging for the fences, as they usually do.
Yeah.
And they, as I say, they generate about half the profit inside JP Morgan every year. Not just this investment group, but generally derivatives, structured finance, all this stuff. So if you say, stop doing this, be careful what you wish for, because you're going to turn JP Morgan into a utility.
Well, what's wrong with that? Why can't banks that are federally insured, that are FDIC insured, and that use deposits, and I know you say that there's other means to fund it, but that at the end of the day, you know, it's depositors' money. Why can't we stop them from doing that and make them utilities?
But you see, the Volcker Rule is really badly thought out. If you want,
that's your beef, because I agree with you there.
Because, you know, let's look at money market banks.
Loopholes.
JP Morgan's no longer going to trade in those markets. We've taken about a third of the liquidity out of the bank securities market, little banks. The big banks own their paper. So now they're told they can't trade anymore. They were effectively market makers for little banks. That's all gone.
Well, there's still a market-making provision in the Volcker Rule.
No, not for this kind of stuff, because they own the paper. The big banks like to own paper from smaller banks because they know them. They're correspondents. High-yielding stuff. They like it. But the other thing is, keep in mind, when you have a bad day in the stock market, say you're Tim Geithner. I don't want to insult you, but let's say you're Tim Geithner, and you would like the banks to come in and support the S&P in the afternoon before the close. Because if the market closes down really badly, it's bad for the next day. Well, under the Volcker Rule, we can't do that. You've taken the biggest desks in the market out. So I think if you want to do this, let's go back to Glass-Steagall.
So you're saying just separate
the house. We'll have a broker-dealer that can engage in speculative activity, execute for customers who want to trade stocks and bonds, right? And then over here, we'll have the narrow bank that has deposits and loans and does other kinds of transactions only for customers. So you basically physically have to divide the capital and the conflicts, and then you're okay. I
am with you there.
But Volcker Rule is a half measure, and it's going to cause problems.
Okay, well, I hate to hear that, but I wish there was more of a call for Glass-Steagall and to go further.
Well, we may get there.
It.
You'd be surprised. Do we have another systemic break in this country, which I think is likely? Then you may have the political catalyst, as we were talking about before, that says, yes, we need to do more.
Unfortunately, that's a high price to pay to wait for another crisis.
But that's how democracy works.
Well, let's talk more about democracy, because right now we have a few diplomatic big events going on. We have the G8, we have NATO this weekend. So this brings me to the situation that the U.S. is in economically, because you pose a really interesting point, which is that you think that there is this choice on two ends of the spectrum between war to juice economic growth when production is not adequate, or debt and inflation, and that navigating between these two extremes is really the challenge. So why do you think the U.S. is in this situation?
Well, if you go back to World War II, we equated the dollar with gold. And on that basis, you were able to fuel the growth of the global economy, rebuilding Europe, rebuilding Asia. And we did fine until the 80s. That's when growth really started to slow down in the U.S. We used monetary policy, lower interest rates progressively. It's like a staircase if you look from the 80s to today. Now we're at zero. We also use deficit spending to goose consumer activity, housing, all sorts of things. Policy was used to generate growth, but was this real growth? There's a difference between real growth and malignant growth, and a lot of it wasn't real growth. Housing bust. Yeah, the Krugmanite neo-Keynesian faction that says, well, we just have to stimulate consumer purchasing power. That's the most important thing. Conservatives say, no, you need industrial wealth. You need to grow real wealth. That's the basis for a stable economy. So by going the liberal route, the neo-Keynesian school, if you will, we're in boom and bust. And I think we have to find another way. Well, at the same time, Republicans love their war spending, and that's a, the Republicans went along. This was
spending.
bipartisan.
Okay.
You know, when I worked for Jack Kemp years ago, we used to argue about deficits in the 80s. You actually got a good bang for the buck as a politician. If you increased deficit spending, you got more job growth. Today, we get almost none.
Well, that's a good point that we were talking about. Has the low-hanging fruit been picked with deficit spending? You don't get the kind of returns maybe that you used to get by doing that, right?
So from a policy perspective, we've run out of runway. And this whole notion that you can use policy in the short run to really stimulate true economic growth is false. And what happens is consumers pay for it at the grocery checkout counter because inflation's much higher than the Fed would like to admit. And so even though we have supposed nominal growth because of all of these short-term expedients in Washington, the consumer's getting killed. And that's the key thing.
Well, and one thing before we go that I want to make a point of is that will this stop? Is there anything to stop it? Because you have made the point that, you know, hard money would never exist in your view in a democracy because politicians will always be pressured to continue doing everything they can in order to provide growth. So then are we just going to, as a country, spend ourselves into oblivion without getting the results?
I think until we have a little bit more of a national discussion about what we want for the future. Do we want a stable, boring growth pattern, which maybe isn't as exciting to the political class, or do we want to go more boom and bust? I don't think we can afford more boom and bust. Because look at the carnage just from the shrinkage we've seen in the real estate market, the housing market, generally employment. We've lost labor mobility because people can't sell their homes.
Yeah.
You know, there's a lot of really horrible, horrible costs associated with this very volatile policy mix. I think we need to try something different.
Yeah, we'll have to see if there's any political will for that, because we're going to have to leave our discussion there for today. Thank you so much. That was Chris Whalen. He's author and senior managing director at Tangent Capital Partners. We just have a couple minutes. Let's wrap up with the loose change. Dimitri, Shannon, we talk a lot about Vice and the boost that Vice gets when the economy is in tough times. But it seems that things may be really bad for one Vice profession in Paris. Here's a hint. Here's a cameo by a famous American there.
American burlesque royalty Dita Von Teese was in Paris again for a 2-week stint at the Crazy Horse.
So the ladies on stage there with Dita Von Teese are on strike at the world-renowned Crazy Horse Cabaret, which is a fancy name for strip club. The strippers say that they're not getting paid enough. So does this show that tough times have gotten so tough that even Vice isn't benefiting, or are they just getting screwed by their bosses? Not literally.
It's a sexy, was a good Freudian slip. It's a sexy type of strike. I mean, if I was going to see anyone striking, I'd be heartbroken at the same time, but it would also be, you know, a very sexy strike. But look,
it's not going to be because you're not going to see them
bankers
anymore.
are huge customers for strippers. All right,
well, they have the money
this
for it,
could
certainly.
be actually a very, and the French are, you know, they lead the charge when it comes to strikes. So, I applaud this, and I may be for their own specific reasons, whatever it is that their salary and wages, but this could be really good for influencing Wall Street, because Wall Street's like, look, if we're going to lose the strippers and the prostitutes, what are we going to do?
I don't know, but we have to credit them for having skin in the game. I like that. Shannon?
It reminds me of the story last year of the women in that town who were holding out from their husbands because they didn't have a road.
Oh, I didn't hear that one.
That can backfire, though. I just want you to know that. Just can backfire.
Okay, but it is along the lines of, in Spain, I think that the prostitute said that they were no longer going to sleep with bankers. But
well, they were taking a more direct approach. The French are classy.
Yeah.
And they're taking this classier kind of, you know, strike a pose.
Strike a pose, literally. Okay, let's talk about this because I want to get to this story before we go. Back in April, former President George W. Bush, maybe you remembered, former U.S. president, obviously, he wished that the Bush tax cuts had someone else's name on them. Well, this summer, Bush plans on giving more economic talking points. He is reportedly coming out with a book with economic advice. The man who did this is going to tell us about economic advice. Okay, really, this story is just an excuse to play that amazing video, which is one of my favorites.
We've talked about the Bernanke contrarian indicator. We've talked about the diamond contrarian. We've been going through contrarian indicators. This guy's the ultimate contrarian indicator, okay? He doesn't know anything about economics. He was thinking about the Iraq war and saying, well, this is great for the economy. And all his buddies on the right, on the far right, the neocons, were repeating the same garbage. This will be great for economic growth. This guy single-handedly sent the U.S. economy straight into the gutter. He literally crash-landed and blew up the U.S. economy, okay, with his deficits, his wars, with everything else. So I'm shocked. This is a joke, in my opinion. Who on earth told this guy that this would be a good idea is remarkable. It's obviously it's a mole inside the Bush family organization.
No, I think it's probably some publicist or publisher that's going, you know, the Bush tax cuts are going to be really in the news because they're set to expire, and this is going to be a huge debate that everybody's watching. So maybe if you write a book, you can kind of, you know, get some leverage from that topic and get some book sales.
That's horrible because, well, okay, that's true. But this is horrible for the for the tax debate because it's not the taxes that are the problem.
Well, those taxes were because they weren't paid for.
What does that mean to not be paid for? Tax cuts not paid for. I mean, that's you know, that's like the left's lingo.
Oh, look, come on! I am not spouting the left's lingo.
How do you have taxes that aren't paid for?
I don't know, Dimitri. Our audience is going to have to figure it out because we're out of time. Our audience is
going to love what I just said.
That's our show. Thank you so much for watching. Make sure to come back tomorrow. In the meantime, you can follow me on Twitter at Lauren Lister. Give us feedback at youtube.com/CapitalAccount, and have a great night.